Welcome to Market Movers. I'm Jim Iuorio, and today we're discussing Fed policy in light of the fact that in February we're going to be changing leadership from Janet Yellen to Jay Powell. We're looking at using 10-year options as a way to position ourselves for any coming rate environment changes. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
First of all, what's the difference between Janet Yellen and Jay Powell?
Well, the way I see it is the fact that Jay Powell is not an economist like Janet Yellen is, or like previous Fed chairmen or chairwomen, all the way back to Mr. Miller during the Carter administration, which, by the way, sports fans, was a complete disaster, the last non-economist that we had in the chairmanship.
I don't have the words to disagree with you on that being important. I'd rather have you being a Fed chairman than some of the economists we've seen in the past. What I thought you were going to say is that supposedly Powell is every bit as dovish, but slightly less regulatory, let's say, than Janet Yellen. Supposedly, then banks could maybe do better in that environment.
Very much so, and certainly being more dovish, though, is interesting because I believe the banks, if you look at the trade in the bank stocks this year, Jim, it's been all about maybe a little bit more of a steepening rate curve, which we have not seen so far this year.
Not seen at all. Now, is the next Fed chairman going to have to tighten because of the economy gathering strength, regardless of what their proclivity is, dovish or hawkish?
Well, I think so. And we've talked about this a lot, about how transparent this Fed has been, maybe too transparent sometimes, my friend. So I do believe that this Fed is going to step into a boiling pot of water that is suggesting that more hikes are to come.
I'm believing that a little bit, too. Now, before we dive into our trade discussion, I'd like to point out that, as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements will vary. When we're talking about this now, the 10-year March contract, which is the underlying of both these trades, is trading about 124.25. Scott.
What a great time to be alive, huh? And if you're alive, you should be trading the ZN these days, because my goodness, has that been a fun trade to watch. So today, I punched up a couple things, as I usually do. You know, I go into some of these trades sometimes, Jim, and I look at, okay, do I want to express myself bullishly or bearishly? And then what I do is I say, well, let me look at the risk reward, and that will tell me what I want to do. So today, I'm looking at expressing myself via a put spread, specifically the 124, 123.5 put spread. It'll cost you about 8 ticks to put on. It's based off the March contract, ZNH. The underlying, as you mentioned, 124 quarter. The trade risk, the 125 that it costs to put it on, with the potential to make 375. Because if you look back at the ZN trade, say in the last, 3 to 6 months, we had an upward trending channel for about into like early September. Then all of a sudden the bottom fell out and we had a downward trending channel that has taken shape. I believe that is the new trade now, and that's what we should be putting on as far as exposure.
And I think rates are going up as well. Prices lower. This expires though in January, so it's not about the changing of the guard. It's just about leading up to that, correct?
And about the news coming out maybe before and being reflecting in price, like you said before the new administration steps in at the chairmanship.
The trade I'm going to talk about is very, very similar. I'm talking about buying the March 123.5, 123 put spread for 9 ticks. So it's almost around the same price here as it expires February 23rd. So you get another month. Like you said, ZN's trading 124.25. It risks 140 to make a potential 359. It's about the same price. You get another month, but you have to dial down a half tick in futures. So it's a similar expression, but mine means a bigger move in a longer period of time.
Yeah,
Thoughts?
I like it. I agree with the bias, and I agree with the timing of it, because like you said, you can take these for what they are. You can take one that's maybe a little bit shorter in time frame versus a little longer in time. It just depends on how the market is going to react to the push and pull of the interest rate cycle, which to me, like you mentioned earlier, is on the hiking phase.
In your gut, do you think there's genuinely any difference in the way the Fed will be run by Powell or Yellen?
Not at the start, but Powell's going to get his sea legs, and he's going to end up getting that Fed under his control, under his guise, and so you probably will see a change, but I'm not expecting that till, say, later in 2018.
Thanks for joining us on Market Movers. I'm Jim Iuorio, where we're helping to make you a better trader.